All right, greetings. Samantha LeDuc, founder of LeDucTrading.com, and thank you very much for joining on this Tuesday Macro to Micro Power Hour. I see Jonathan right there. We're going to promote him to panelist and chat about the markets and potentially any market structure changes we see under the hood, as well as some other discussions on doom loops and equity nirvanas, which is Jonathan's great expression that he has used before. And I thought it was fitting, given that we seem to be doing all of the above in the matter of one day. How are you, Jonathan?
I'm doing all right. How you doing?
Oh, it's good to see you. You have been working so hard, beyond hard.
Like a crazy person.
And I want to just quickly point out, this is Macro to Micro Power Hour. We do it every Tuesday. Jonathan, I really thank you for taking time out, because I know right now you're doing a major release of your platform. Speaking of which, it is here, vigtech.io. And I would love if you would also kind of catch us up. What is going on in your world with this platform before we talk markets? Because you're, just cooking with gas. What are you working on?
Sure. So right now we did a beta release in the fall. So we did that from October, November, December, September, like late September, October, November, December. And then in January, February, March, we've revamped everything based on the feedback we got during the beta release. And we've been working with you on a bunch of your indicators, and we're building out an entire suite where people can create indicators and things like that. And so this is a full blown, like kind of out for release for the product that's coming April. So first week of April. And we're supercharging up a lot more data, a lot more visualizations. One of the things that is happening in the space in my mind is that the access to information is growing, but the depth of information is not necessarily as rich as what people think. There's a lot of surface data floating around, but you really need depth of data. And so we've added a lot of depth of data that's going to help kind of expand on what people look at, and then also create the environment where it's not just data, right? So rows and rows and rows of information. Usable visualizations is a big kind of theme that we're going to carry forward in the spring. And so we've got a whole new release of the mobile app, a whole new release of the web app, a whole new website, a whole new marketplace. That's all coming. Yeah, so much going on. And so first be the end of the month, first week of April, and then we're really going to really supercharge options. There's so much that can be done with options. This is, I'm not gonna say a whole lot more than that. It's just is a whole supercharging of the options environment, what people are gonna be able to do, see, create on their own, et cetera. So we feel like, and that kind of ties into the conversation today of the doom loop and equity nirvana, with options and derivatives so far surpassing the underlying securities. To not incorporate options, whether you're a CFA, an RIA, a day trader, a swing trader, just a regular retail trader that's trading on a, every once in a while basis, is kind of crazy at this point, because
they're not even every once in a while basis. I just tweeted out today that retail volume has surpassed mutual fund and hedge fund volume.
Yeah, it's a new world. Yeah,
it's new world. And they are going off these meme stocks. This is true, but the option, and we also know option data is, activity is absolutely swamping the markets. So the new not normal, the new world, however you want to put it. So you're going to drill down a little bit more and make this I guess buildable for those geeky types that want to go in and create their own algos and such. Because right now you're building mine, like you guys have literally taken my stuff and put it on your platform. 3 products, different time frames, and the data underneath is similar, but you are literally helping me manifest that visually and with signals, and it looks so slick. It looks so good on the desktop and the mobile. It's a gorgeous thing. But I know this is something you want others to come in and kind of, with this agile development, build their own. Is it be a real marketplace for others to come in and do their own thing?
Yeah, so it's like I think it's one of the principles of when you and I met, and then like kind of the way I look at the market and in business, it's like the hive mind. Like I could sit here and say, I know everything, or I know the market's going to turn, or the market's going to do this. It's not really realistic, right? Like one person would never be able to create everything. I do believe that, or the best product in the whole world, right? Like, Amazon is a marketplace as a service. Roblox is a marketplace as a service. Pinterest marketplace as a service in its own way, right? It's where other people are able to share their ideas and manifest their ideas in an environment that gestates that idea into reality, and then it can actually cause a lot of things to change and be modified, grow, expand, etc. So my whole thought was we need to build a platform across all aspects that can integrate data across all aspects, because so many products have just maybe options, or just maybe charts, or just maybe screening, or just maybe this, but to get the entire data set to where you could cross-pollinate, your thoughts, your energies, what you're seeing. Like you and I were talking about your stuff, where your patterns, you were seeing these patterns across multiple spaces, across multiple different facets of market structure, and you'd be able to take different pieces from all those, which we've done. No secret sauce being shared here. Sorry, guys, but like they're cross-pollinated,
yes,
right? And then they are able to deliver those type of alerts, those readings. Yeah, and so
one of the things I loved is that this data that you have is also, it'd be very expensive for me to do on my own, and the next person to do on their own, and the next person to play. So you are aggregating the marketplace. It's much more efficient, and it looks so good, and you're very responsive on that development side too. It's a beautiful thing how it all, for me, it's just slick.
Yeah, well, what happens is, like, this is we were running out with a few people and kind of sorting all this out, and then the back end is getting constructed to where everybody would be able to come in there and kind of building blocks, right? And this happened over the next few months, where you're able to create different things. You've got different types of charts or visualizations that you're looking for, but we've already got the mobile set up to where it's such that you want to offer alerts, or you want to offer this, and it's such and people you guys haven't got to interact with that on the beta test yet, but it's really killer. Like the mobile piece. Like for me, I was like really working today, so I don't have a lot of time. XLF, I've been watching, and I turned on your indicator for XLF, and I was like, hey, let me know whenever this changes for the risk range alert, right? And it hit me when it went from bearish or bullish to neutral to bearish, all in the same day. And I was like, all right. So now it's like that kind of thing about life that I think becomes the active management, because that's really the essence of everything. It's like this infrastructure that you would need to create something like that to deliver great value is now there in place. And I get a better reward as a investor because that's in place. And it doesn't take you forever to get that into a usable state. And that's the key to like going forward in my mind of the marketplace, because it's not necessarily like going to be a passive marketplace with all these people participating. I mean, I think it was already going active to begin with back in 18, 19, 20, but then 20 supercharged it with everybody staying at home. So now everybody's got the bugs like, hey, I can do this too. I think that's really where this is all headed in the next couple of generations. So, and even with more data accessibility, because the exchanges are really trying to make more data accessible. They're not trying to hoard it, they're trying to make it more accessible, but there's so much data at this point, and how does it all intermingle, and how does it all work? That's kind of these things that we're sorting through. So I'm really excited. This is, your stuff, the fascinating thing is like the depth of the quality of these readings, like the stuff for that you've created is like it's like kind of mind blowing. It's like, once you aggregate this and data points together, and you're able to simultaneously do, we couldn't track this. Like, I started trading in like 2007, like 8, it's like, it is old school type platforms, you got E-Trade back in the day.
Because people like to talk and figure out the puzzle. And that's why we do this on Tuesdays, because there still is a narrative. We want to match the why. Right? We don't want to just be robots. Some people do. There are those,
Well, what's wild is like you can synthesize so much information mentally. Like I can only synthesize so much. Like I'm tired, I go to sleep, I wake up tomorrow, I might be tired again, right? I'm not able to like, be firing all cylinders all the time. But this stuff is like, it's rules based. So like anything that's rule based, you can start to see, especially once we start adding the visualizations to different things. Like, it's like options market, and you can see it, not just trigger, just see. You can see it.
I can't wait, because there's so
literally
much.
See it, right?
Yeah,
and that's That's like a whole next level of what you're able to do with it. Like, markets never go away, and that's one of the things I think everybody like kind of trips up on with some of the like algo trading or HFTs or whatever. The market's never going away in the sense of these new things don't change the market. They just change the way the market functions. That's it. So it doesn't. So the puzzle's
No, I
always
think it
going to
becomes
remain.
a faster, more accessible way to read the market. For me, I work extremely hard to figure out what's going on,
Yeah.
and how the market
Yeah.
will react, and then how to position for it. And if it doesn't, why it does. There's so much here, it's exhausting. It is
Yep.
nice to have,
Yep.
signals that actually kind of do that work. It's very much price based, which I tend to not like to only do price based.
Right.
But there are people who only want to do price based. They don't want to be in my trading room. They don't want to read my posts. They don't want to hear us talk.
Yeah. Well, I would say
It reaches a much bigger audience.
there's analysis and then there's augmentation.
Yes.
Right.
Yes.
Augmentation is not automation. Right. Automation is where you're gone, I'm gone. It's just a robot doing its thing. Right. The algo bots. Right. The augmentation is the better decision making. So how can I get the system to help me, synthesize more information to make better decisions, to make more clear decisions? It's like literally what we're going to talk about in a second. It's like why I did not believe that last week this was going to roll over last week. Right?
But you absolutely had the numbers though, which is your pattern recognition. It isn't a bot. I mean, we can do this both ways, right? We can do it with an algo. We can also do it just from experience of looking at these levels, saying, here are the reasons why this is not likely to get above. It's a higher probability short than a long. So, and we need to talk about that in regards to the market and rate volatility and, the dollar impact and what's happened with oil. So we're definitely going to talk about all the market stuff. But I thought it was very interesting that, you have just been really nose to the grindstone, working nonstop on making this live, the new platform with all the functionality. It's, for me, extremely scalable. So I'm just like, go work. I'm not going to interrupt you, but on Tuesday, can we still talk?
Yeah.
Because
Well,
you did call that last week, this time, where it was going to very likely roll over, and we did. So congratulations. That was a good call.
Well, it's then, and we didn't talk to like end of last week. I didn't see the VIX. It just didn't come through. And I posted a couple, I just throw some stuff out on Twitter when I can here or there. But there was nothing that you added. There's an elixir to the doom loop and the equity nirvana that you got to have for it to the concoction to fire. And it did not, the VIX did not come through. So I was expecting more of what we saw the past couple of days, like where it's bounced, like especially today, like kind of shallowing out yesterday and then strong bounce today. I without the VIX doing its thing, then you simply are going to get the buy the dip mentality. So it was, for the market purposes, we can get on that in a second. But it was these kind of like, if you don't have, I'll show you guys like the volatility read we have in a second. So we create our own term structure, right? So you should use the VIX formula, and you can see that like the last year, the VIX was just insane. But the last couple months, the last 3 months has been a more neutralized state than at any point in the last 10 years. Right?
Neutralized. So you didn't use the word suppressed.
No, it's just neutral. So you could say suppressed. You could say suppressed. Like there's short.
No, I think neutralized or neutered sounds better.
Yeah, it's just neutralized right now. So you've got this state where until VIX comes back into play, the equities, being so driven by the options now, especially securities being overtaken by the derivative contract, that you're going to continue to see, this situation with the VIX to be more important. And you've got all these kind of ancillary things going on, with rotations and stuff and so forth. And I get on that. You cover that in a minute, but like
that's my thing. Yeah,
you can continue to do that stuff as long as this VIX situation doesn't pop out and explode. And that's one of those things you got to monitor. And I think it comes down to game theory as it relates to the Fed, where we've talked about the chairs in the room and the table and where everybody is like sitting and there's not much left. Because in an environment where Powell says, and he says this all the time, the market's not functioning normally, right? Well, to them, if you think from their seat, functional market is no vol. Like the rotations are fine. somebody wins, somebody loses is fine. They hate vol. Like vol is bad for business. And so suppression vol, short vol trades, that's supported. He's talked about short vol previous to 2018 when it blew up. And so as long as that trade is kind of in that suppressor neutralized state, then you get just constant rotations. You get a constant, equity.
Right now
Nirvana.
it's from momentum. The growth to value is in full view the past few weeks with the NASDAQ or the high tech definitely selling off, which was why my prediction that VIX wouldn't actually move, but the tech would sell off. And then 4 days ago, I actually thought VIX would start, because this keeps moving, from the rate volatility into equities, specifically tech. And I did tell clients repeatedly, I don't think VIX is the way to manifest this trade. I just think directional puts or put spreads on key tech.
This is a good call.
But then 4 days ago, I said, I think it's actually time. I think this is actually rolled into potential currency volatility. And once that happens, I think volatility starts to go. So we haven't seen that. We saw the dollar bounce, very strongly, got right up there into resistance, and then a little bit, stepped back yesterday, and the euro bounced. But I'm still very much eyes on the prize. I still think we can have the next leg be rate volatility, which will then trigger volatility of volatility. So I haven't seen any of that yet percolate up in the past few days, but there's
100%. Yeah, 100% agree.
We got all kinds of events coming up, and not just the CPI tomorrow, but the Fed on the 17th, and there's still a lot to talk about in the interest rate world. And oil, by the way, that shocked me. We got firmly above 65, which was my line in the sand for oil. And I ended up getting completely transfixed on that whole idea of higher oil, and wrote a big long post this weekend on oil volatility, rate volatility, and then this year of the currency volatility coming our way. So I'm ready.
Well, it kind of ties back to everything we've been saying. If people have been following, it's just kind of an ongoing discussion of the legs at the table, right? Like, you had
knocked out.
They keep getting knocked out, and eventually, we've got. And I was noticing last week, you said, you remember I said the Dow, 31,600 was the marker, and 32,000 would be like the bear's last stand. And it tried to hit 31.6, and then that got clobbered decently, but nothing like tech. Tech was like the Momo trade, the options trade on all that Momo stuff got hit pretty hard. Kathy Wood took it pretty tough. That got unwound a little bit. Then you had the straight, kind of FANG stuff get unwound a little bit. And so you kind of
was actually first.
Exactly. So everything rolls, but you only saw that over in tech because the Dow components, they held. Like they were strong. That didn't sell off. Because
old tech all of a sudden got a revival.
And then you got all the travel, and you got all the airplanes and everything else. So it's like and the banks too. Like I had some Amex shorts, American Express, and I had XLF puts, in last week, and they were in the money. You got them at the right spot. They were coming down, and they just got it just. And they got taken away because I had moved my stock. I was laughing. I was like, well, yeah, it's not time yet, because if the banks and the kind of the value plays, all that still has not met its crescendo, right, to the rotational trade, then it's still something to move to. And now you see the perceived value now, maybe in Futu and Fubo and all stuff got whacked 50-60% last week. I saw there's a lot of people ready to jump out of their Tesla.
Those are the kinds of bounces that we get often in counter trend.
I agree with that.
Extremely violent, and they are.
Market structure broke on all that stuff, and so that stuff is now in the downtrending situation with violent reflexive action. So I think that overall, the SPX, Russell, YM, they're still kind of meandering, and this thing is still kind of leaking. VIX is still subdued, and then you've got the tech, which is already, it's already turned, and so this is reflexive. That a normal bounce is 2-3%, 6, 5, right? The guy posted something about the ARC stuff earlier, 14%, some of that stuff, 15%.
Tesla 20.
Yeah, so it's okay, it's reflective, right? So you got to take into account, so this new bull market, highly unlikely. So I think that,
That's what people get excited about. They see a very large bounce and they think, oh, the bear market for these tech stocks is done. We need more than a one-day wonder. They're actually,
follow through, break the market structure back up. Most of this stuff bounced right off of its volume points of control, like major areas of the market that were heavily traded for a long period of time. Like Tesla number was 600 for a while. People thought I was crazy, and then the other number is 2 something. So like, don't shoot me. Like, if it loses the 600 area.
Oh, it looks like a 500. But there is one chart I would love to show because it's something that I at least mentioned. Hold on, let me just grab it real quick. In regards to NASDAQ, because it's an interesting one. And you know me, I like to do this intermarket stuff, right? To kind of give some indication of where we're going to potentially bounce. And where is it? There it is. All right, so here, let me just share this real quick on my intermarket stuff. So this is NASDAQ, obviously, from 2008. It shows up as a very slight blip, right? Pull down of what we just had. It's not momentous. Did that just freeze, by the way? Because I have, can you still see me in my chart? Okay, strange. Okay, so it doesn't look very much of anything, although we know that stuff under the surface fell 20, in some cases 50%. It has been dramatic in tech. I don't know if you see my arrow down here on the corner where this purple box resides, and this was taken this morning. So I did this obviously for our talk. This is, for me, very, very oversold. And it means one of 2 things. Either we have a lot more basing to do before this is a safe long. In other words, it needs to come down here and stabilize and then reverse and move higher. Can you still hear me, Jonathan?
Yes, I can. Can you hear me?
Yep, but the picture froze, which is why I'm just not sure if anyone else can hear us.
Yeah.
Okay, so this showed, and then when I go back and then I pull this back, you can see where we were extremely oversold here. And that was obviously the March 23rd Fed intervention though too, right? So this was trillions of dollars came into the market and boom, we went higher. I come back down into this area back in October of 2008, October of 2009, and we actually hadn't bottomed. We actually kind of stabilized a little bit. We had several weeks and months of sideways before we actually, got it together. And it's kind of interesting. I didn't cross-reference any Fed dates during this time, but I bet there are absolute correlations to Fed intervention during these dates. Just color me skeptical that it's just momentum. But in any case, the point is, I think this can go on for a little bit more time. I don't think in any way, shape, or form is this done. This needs to settle, needs to base, needs to reverse, and it can go on for months and months and months and months. That's all I wanted to show.
Yeah, no, I think that's totally accurate. I think that the market structure for NASDAQ got pretty licked. If you look at the underside of some of those names, they were, 30, 40, 50%. This stuff is like, one of the things I take into account is like how extended we are, and then how like the market really works nowadays as relates to the game theory statement earlier with the Fed. So if you look at like the history of the kind of the Fed put or the stimulus that has come into the game, the last 12 months has been fiscal plus, right? And so I think that one of the things so plus monetary. So I think one of the things, and I mentioned this many times in the last couple of months, one of the things I think has got to be incorporated in the views, even looking back to the historical back testing or the historical perspectives of any of those pictures, is now we have fiscal, and how much has that distorted some of these readings, which may look like liars, right? As stuff bounces and then it's good, but then it doesn't. It doesn't stick, and it rolls, and it proved to be a true tell. And so I think that the fiscal with the stimulus checks and so forth that come back in, plus the deal, Green New Deal, whatever you want to call it, that's passed the infrastructure. And then what is that? And somebody sent me, James from Texas, one of my guys, he sent me some stuff about the pension money that was buried inside of the 1.9 trillion to shore up some of the pension stuff.
86 billion to keep them
Super important, super
alive.
important.
Yeah.
This pension deal we were talking about at the table, the table, you got the pensioner at the table, you got the hedge fund short vol guy at the table, you have the young players at the table, right? Everybody's at the table. Somebody's going to lose here with the Fed unless they can do something just that we have yet to see with fiscal and not cause inflation. They are concerned about the inflation. So I think that when you look at these kind of broad picture things, we got to incorporate some of the historical context of not including some of this insane fiscal at the same time as the modern monetary policy stuff that we've done that would then add flavor or color to those readings, right? So like if you look at like, what was it, 10, like 9, 10, some of those markers in there, like I don't believe we had we usually had fiscal off and monetary on, or like vice versa during those whole cycles. And it was usually the Fed that was drawing up, the kind of pushing the thing up. Well, now we got both. And so these readings, are we going to get wilder readings? Like I see some of these readings that are like, oh, this is the most wild reading. Not stuff you've shown, but I saw some stuff this weekend. It's like one of the most, overextended readings of all time. And I'm like, but isn't everything overextended right now?
Oh no, I did that one. Hold on.
Yeah.
This was one of the most amazing charts in regards to the rate of change. Is that what you're referring to on the 10-year?
Yeah. Well, not just that, but like there's stuff everywhere just like that. You had showed, I know exactly what you're talking about. You go ahead and show it, but like there's another one that's related to like it's related to the cues, and it's related to, usually this is the sign of like an impending bottom and so forth. But it's like you gotta be thinking in the context of maybe this information is a little distorted right now as it relates to like, because all things being equal, right, is the phrase that you'd have to utilize. Like, is the underlying data set the same at that time and at this time? And I would have to say no, right? So these things are not, which is why you're getting these readings across like this. This is one. It's like 100. A total max out, right?
So, but this to me, I interpret differently. It's my chart.
Yeah.
So I interpret it my way. Okay, you do. Everyone else can do their own interpretation, but for me, when I study rate of change, okay, it is all about the speed and the strength of a move. So this is the 10-year, obviously over many decades, and you can see where it has gotten occasionally into some overbought. We'll call it overbought, like an oscillator, okay? And it has stayed there for a while. So my whole point is that this has indicated points of strength for a duration of time before they roll over. And this puppy right here, which I showed clients this last year, going, this looks like such an inverse head and shoulder, which tells me that this yield curve is going to get steeper and steeper and steeper, and yields are going to go higher and higher, which is why I like that reflation trade over and over. I keep going back to that well. So
100%.
This just, even though it's come back down, by the way, this is the 6th, and right now it's about the 80, doesn't matter. The fact that we shot up like hot fire flames is the speed and the strength of front running. The Fed is like, okay with this. They kept coming on. Bullard, Bernard, sorry, and Powell. So they didn't talk this down. They let this move happen. So to me, this has more strength. It's more durable. That's how I interpret this chart. And other people will say it's an outlier and it's going to reverse and crash as a deflationary impulse, which, by the way, it could if the Fed, when and if they come out and they say, you know what, we have decided, yield curve control would be a good idea. Then that sucks liquidity out, right? Yeah. Which is actually bearish for equities. I don't think they're going to be very quick to do that, honestly.
Months. Yeah, they're probably going to see, I think, realistically, you're going to look at them and say, what are they probably looking for? They're going to see what the reopening looks like, right? So they're going to be very, very kind of, equities are down like to what, 2%, 3%.
But it isn't the equities that are down. It's the tech froth that's coming out. The SPAC ETF was down its, 78.6 fib retracement, and it was a gorgeous, drop. Yeah. The high flyers, yes, the ARC, of no dividend, high growth, no profitability, zero. So they're not profitable. They don't have dividends. but they're high growth and they just collapsed 20 to 40%. It was breathtaking, right? So people are trying to trade to make up for their portfolio losses. I think the Fed's okay with this.
Yeah, that's what I mean. It almost like worked out for him last week in a sense, because you got some of the excess pulled out on the Momo stuff, but then the value and Dow stuff played out fine.
I gotta show
And you get the rotation that works, and you don't have a VIX spike. So it's like literally like Merry Christmas, right?
Brilliant orchestration, in my humble opinion. I think this is exactly what they wanted. Okay, so take a look at this. This is Eric from Bloomberg. He's talking about outright feeding frenzy. Can you see right here? Yeah.
Yep. Good.
Okay.
Yep.
Okay. There's outright feeding frenzy going on for value ETFs right now, which have taken in about 5 billion in the past week. That's a good month, and 20 billion year to date. Nearly. You know, look at the records. Just incredible. In all, 80 value ETFs have taken in cash, and here's a look at where the money's going. Then he continues on. I'm getting to the punchline because this is like, for me, I'm the rotation. I love rotation because I can see where the money's coming in, and it's basket trading. So it's energy, it's airlines, it's I don't care what, it's Momo, but you can see the rotation, and it's such a beautiful trade. Interesting and yet kind of predictable. Most of the cash is going to the watered down value ETFs, even though the pure stuff is popping way, way more. But the point is, he comes into, okay, the year-to-date returns. You can see this thread. I have forwarded it. But that said, if this value comeback is real and not the 28th head fake, then watch for one, maybe two of those 4 ETFs above to be the next era's arc. Calling it now. And I got to tell you, I have been writing about this. I have been talking about this because I think this rotation, and when I say I've been writing about this, talking about this is a post I did this weekend for clients. But just for example, and we started talking early fall, right? But April, the client, post rotation into value setup. Violent rotation. That was, we hadn't even hit the historic one yet. The case for value over momentum, value takes flight, historic momentum factor rotation into value. That was an 8.8 standard deviation move, which by the way, had to be unwound, and it was. And then value is wicked oversold. That was July 14th. Then rotation into value is underway again. Then we had the September 4th, which is what I call the peak momentum to anti-momentum rotation. I'll show you that in a chart in just a minute. October 9th, the Biden bid meets value rotation. And then I did my first of the year Stock Charts TV 2021 predictions, where what am I calling for? Small caps over mid cap over large cap. So I'm really very interested in this theme, that this has strength, speed, money flow. I don't know. That's me.
Listen to this anecdotally. So it kind of could throw in some merit to an even deeper situation globally, right? Like I've been told by multiple different exchanges that their largest sales this year for like exchange data is in Asia Pac buying US equities access for their younger populations. So new fintech apps and stuff like that. More people are trading US equities than have historically, even internationally, right? So then you got this type of rotation trade where you're going from like, what's expensive to what's cheap, then picking up the tail, so to speak. This stuff is like, it's got a lot of legs. And I think when you look at, like, I'll show everybody the Doom Loop and Equity Nirvana. I wrote an article and they put it in Tabb Forum, and it really explains all the equity.
Oh, good. Okay, because I was going to say, right? Define those terms.
And so really what it'll be is like, we have a singular or a binary market, right? Where it's this rotation based off of kind of not just seasonality, but a lot of all the different macroeconomic factors, right? They could be coming into play. And those are all, I would call them healthy. Those are healthy things based on the seasonality of the economy. You got the reopening, you got the cruise ships were at zeros. Now they're like coming back. The airlines were at zeros. People are flying again. These things, that's like good, it's good business, much less like good investing. That's like good business by stuff like that. So when you look at what can interrupt that, the only thing that interrupt this type of stuff now is this, because of the construct of the market, because of the way that it's kind of unfolded, where the derivatives have overtaken the amount of securities, and it's all good when it goes up. What really makes it vulnerable at any given time is the doom loop, right? Which is this kind of concoction of a formula of different things. Let me just share what that is.
And I thought you were going to say, which is GameStop.
Yeah. Well, like, that is just, that's kind of like the
shorts have taken it on the chin stronger with GameStop going up. What was it? Oh my gosh, what was the number? 11 billion right now in losses on shorts for GameStop versus only 4 billion on Tesla shorts.
Why would you short GameStop like, at this point? Like they got a if you've seen any of these meme videos about deep F value, like where he's Rocky, and it's like this is a hero thing, right? Like
Forrest this is Gump. Yeah, I've seen
this is a totally you're fighting a slug of the market structure that wants to see this just succeed. And it has really nothing to do with like oil or anything else. It's just literally the one stock.
It's a revolution.
Something.
They call it a revolution.
Right. So when we look at the doom, let me share this.
Go ahead.
And I'll walk you through.
I gotta give you power. Sorry. Why does it do this?
To protect everyone. You have to get
permission.
Okay. All right. So I'll send the link. I'll give you the link to the article, and people can go get it off of Tabb Forum. But basically, I won't go into everything. I'll go into the details of Equity Nirvana. But it's the market cycles, right, were really interrupted in effect because of the short vol trade and the interest rate target, right? So short vol targeting and then passive indexation. A lot of work been done on this. I'm not the one that pioneered this, but that's pretty much given at this point. You got short vol, you got passive indexation, which is one time frame buying. So money comes in and it's going to get bought indiscriminately, and then the interest rate suppression for a prolonged period of time. That gave us what would be a prolonged period, bull market, what have you, but equity nirvana, where there's really no negative bid. And that's not a normal market structure. Normal market structure, like you go to an auction, people are buying and selling on different sides to find the actual price. And in 2018, and really what happened was, and Lily Francis has done a bunch of work on this to look back at the actual spread of options trading going back to like the early 2000s. Once Robinhood comes into play, options trading explodes by just proxy of access. So people have more access to trade options. And this is a feature, not a bug. We've talked about this at length. I won't go into it, but basically, if I can trade 100 lot contract order because I don't have a commission, that it's a totally different game. I'm trading a lot more options, right? So the options contracts start getting really heavy in 18, 19, and 20. You can see the bifurcation of the old kind of environment to the new environment. So it's like a cone, right? So you see a lot more options being traded. Well, it's a natural thing that happens once more options get traded, which we see these really extreme kind of moves, much more extreme moves than we would see historically prior to like 17. And that is where you've got the big gamma, right? So you've covered this a bunch. Spot Gamma has done great work on this. Squeeze Metrics done great work on this. Gamma exposure, respectively, when dealers got to sell calls. So we got all this new call activity because people learn how to buy calls first, like buy calls because everything stocks go up, right? So instead of learning puts, put spreads, bears, all that kind of stuff, you've got just simply call buying, right? Well, the dealer sells the call, got to buy the underlying to hedge it. That's a feedback loop. And so you get that impact plus passive indexation, plus short vol trade. You get these kind of grinding higher environments where it's pretty safe to rotate, right? Smart players rotate, other people pile onto the momentum, right? So positive Jack supplies liquidity, right? And then short vol, right? When there's positive Jacks, it also decreases IV. So, liquidity is abundance, or the perception of liquidity is abundance because of the Fed, right? You got gamma kicking in. You get outsized moves to the upside that never have a negative bid. Institutions sell puts at much lower levels, right, to create yield. And then vol short sellers target vol to create yield because there is no yield in a negative, interest rate, zero interest rate environment. It's all based on the perception of liquidity, right? And the abundance of liquidity, which right now we have in spades because we've got fiscal, plus we have monetary, right? So neither of those, so there is literally no fear of liquidity. And when people start getting fears of liquidity at all, you start to see it show up. That's why I said last week, I was not really convinced that it was going to roll over much more than it did, as far as maybe more of a correction versus a doom loop. because there's still no perception of liquidity problems because people still think that everything is good. And you had the $1.9 trillion vote this past weekend, which I would, I made a joke some privately about people going into the weekend short ahead of that, right? That's bad move. This can go into never land, right? It can continue to break records. It can continue to set, you saw the put call ratios, we covered put call ratios. It can just go on because you have more people buying calls, right? It's just in excess, right? Across the board. And then there's call buying. And think about this, like we've looked at stuff where people are searching for calls that are under 50 cents, specifically under 50, under 25 cents. So this is literally you've got to account for this as it relates to trading. So what breaks this? Well, because then you got what I would call a one-sided market then, because everybody's on one side. What happened in 18, what happened in the end of 18, February 18, the end of 18, and then in 2020, you get this just period where immediately things just get off the handle. Like it's immediately out of control. Well, short sellers get squeezed. That's the first thing on the vol trade, right? So when the vol trade gets squeezed, those guys immediately, because that's the most violent trade you could be in, a shorting vol, right? Like it's very violent when it goes wrong. It's very profitable historically the last 10 years. And then it goes to zero. So XIV, for example, right? So there are a lot of these short sellers, right? Pensions, institutions, hedge funds, they all engage in this short selling because it's a yield process, right? Like UVXY, is everybody seeing UVXY? Have you seen a chart of UVXY? The thing's literally built to go to zero, right? So like when you look at these things, you can see that they're structured for that short trade. Well, that trade can blow. Well, a rising VIX comes right after the short sellers get anaconda squeezed. And that means liquidity is deteriorating instantaneously. So
rising VIX, say it was the last
rising VIX is basically it means that liquidity is deteriorating, right? So the perception of liquidity being great to liquidity is deteriorating, and everybody's on the wrong side of the trade. Then you got short covering, right, on the short vol trade, right, which spikes VIX higher. So as liquidity disappears, institutional demand on the market starts to run away and leaves the market in the hands of the single time frame ETFs and retail buyers, right? So with rapidly falling prices, and those are not geared for the high volume. So once the rapidly falling prices come in, option dealer switches, right? So because it goes from positive checks to negative checks. And you did see that last week only in QQQ. You didn't see it. You saw it in the NASDAQ, and you saw it just go bidless. It felt bidless. It just sunk, right? It did not crater, right, completely. But I would say that, 10% overall, like, I think it did hit 10 or 11% at one point. When you look at ARK legitimately suffered heavily because their puts are, they got in a doom loop. It was down, what, 30%, something to that.
37.
Yes. All right, so negative JEX is reducing taking liquidity, whereas positive JEX is supplying liquidity. You got spike in VIX. So the thing that we did not have last week that was, correction, right, or not even correction, just kind of like meandering in time, is there was no real concern of liquidity in the value structure. So the Dow, Russell, or SPX. There was just like kind of sideways action. And none of this was really anything outside of the tech space. Tech space had its own little kind of period there, a little vacuum. So the way that this blows out, and I encourage everybody to take a look at Squeeze Metrics' paper on this, because I think he's exactly right. Some people say, maybe not sure about this piece, but I think he's right. It's the sold puts that got sold way underneath the market, because once a dealer, is selling a put, then they're actually hedging the underside of that. So it's not the put buying that really gets out of control. It's the put selling at the end that really sucks it way down and out of control. And there's some really dynamics to that. He shows some great charts on this, but there's a white paper he wrote on the liquidity deterioration that I suggest anybody that's really nerding out on this stuff, how those like kind of apex bottoms occur when the bottom, it just falls out. And it's all the mechanics of the options market that causes these steep drops to occur very quickly. So doom loops, right, is where there's nothing working, right? It seems like there's nothing working. You saw that happen in late 19, Christmas massacre, right? In late 19, it just, there was no bid, it was bidless. And you saw us in 2020, it was bidless. And it's offsides moment as it relates to liquidity. Now, what I would say is, as we go further, this type of market structure that's directly influenced by the options, the options market and the VIX structure is so kind of in the one-way street. Either it's in line and it's suppressed, or right, it's totally out of control. And it gets out of control in a session to 2 sessions very quickly. And that market structure flips, these pieces fall into place, and the shorts get squeezed right on the VIX. And that the VIX itself and the SPX itself are the primary players to, everything else. You can see QQQ or Russell kind of go in their own buckets here, both up or down. This is really related to SPX being the largest. And I think that this SPX and VIX relationship, so SPY and then VXX, going to overlay to that kind of very subtly, but like the VIX and SPX are the keys to this piece. And so the doom loop and the Nirvana cycles the doom loops can be much more vicious. And what happens is, since you didn't have any transactional buy side, sell side action on the way up, you get what I call Gorpy action, or just kind of this fleeting rise that has a lot of holes in the market structure. Typically, typically in an equity Nirvana cycle, you see these periods, especially overnight, where the market will gap up 1%, 75 basis points, 1.5%, and it just leaves it. And the ETFs immediately come in because they are triggered one time frame, right? So their mandate, and they start buying immediately. So you get that gap ramp and camp behavior. The question that I think is probably worthy of discussing at this point is this kind of towards the end of this regime because we've kind of created all this, or are we at the beginning of this regime? And a lot of folks are saying, oh, well, this can go on indefinitely. And I think, realistically, this whole Nirvana and doom loop structure being kind of fostered by the zero interest rates, short vol, passive indexation, can interest rates be, where's the Fed going to go with those? As it, what else can they do? We've talked about this with 3 legs of the stool, getting knocked out, or 4 or whatever, based on how many we've had knocked out. And then we've got the, fiscal policy. Fiscal is not monetary. And then, banks, you posted about banks lending, right? This morning, I think, is that right? Was that you? So if banks playing into this as well, I think that when you step back in the longer term perspective, this is going to be something that plays into whatever the next kind of moment is. And we're not seeing that yet, but the next moment is now with an options market that is what, 2 times, 3 times what it was a year ago, right? And we've got all this concentration into singular names. So there's an argument to be made that we're going to see some real fireworks in the future. Because of the way that this is simply structured and the fact that it's an unintended consequence of what's been let to occur. But I don't think that there's really much choice because interest rates can't be raised. So that's just a basic kind of overlay of the Nirvana doom cycle. I'll send a link to that article and everybody can take a look at it. But I think what it really breeds in the last part of the discussion is it brings in more active management, because you're not able to just simply set it and forget it. You got to do a lot more what you're doing, which is rotation. And you can see that, like, you look at the ARK, if I say I'm going to set it, forget it with ARK, yeah, I'm up 100%, and now I'm down, half of that's gone in like 6 days. I mean, these moves are quick once you get that suck out on when the options go the other way, because everybody's immediately starting to, buy puts, and then negative gamma kicks in. So, I don't have a crystal ball. I don't have anything like that, but I think it's a one-way street. It's a binary market structure. And, you look at the bid since the March of last year across the board, that's what it looks like across everything, right? So you go from value to momentum to energies even come back. The only thing that doesn't look like that is your kind of currencies and your PMs and stuff. Like even Bitcoin is, kind of in that environment when it relates to liquidity. So I think is the derivative.
Very much so.
Right.
Yeah.
So that's I'll kind of leave that there before I yammer on too much. But I didn't see one last week. I didn't see the VIX. I didn't see, the pieces of the puzzle that have come into play that I think are just really kind of a replay over and over and over again. So without the VIX, you don't have anything to really kind of hang your hat on to chew on deeper in the drops, right? So it was bought. And
well, I have a theory about that.
Okay, go for it.
All right, so this is true. Going back to the 2018 and that Gorpy action, actually January of 2018, then again October through the Christmas Eve massacre. So October 3rd through December 23rd, we dropped 20%, and it was very much a rate story. So we had, tapped out at 3.2% on the 10-year on October 3rd, and that introduced emerging market stress. And then we just really went right down, especially the Qs, until Mnuchin talked to the banks, right? The famous call to the banks on the 23rd of December. So this go round recently, where we had just a yield pop, strong one, that 100, rate of change, for example, in the 10-year, and a steepening of the yield curve. At one point, finally, it went, oh wow, we really are moving higher. It just seemed like, what was the rotation, since yields were very firmly bid, and bonds now have traveled down 20% from the August high, right? Gold is soft. There's no hedge in bonds. There's no hedge in gold, and volatility, as you have mentioned, and rightfully so, it's neutralized or neutered. So what got a bid, a relentless bid? Oil. Oil got the bid, and it got a strong one. In fact, it surprised me because, and although we can't really big picture deal with much higher oil as it relates to, it's a headwind on our economic recovery. If it stays above 65, it's going much higher.
Totally.
And that's my thesis. So I have that rotation, if you will, of into value. I don't think it was as much a value trade as it was, oh my God, we don't have a hedge in bonds. We don't have a hedge in volatility. We don't have a hedge in gold, any precious metal whatsoever. The dollar looks firm, looks actually like it's moving higher. Oh my God, the dollar's moving higher. Where do we, that's one, rotation, but there's so much emphasis on suppressing the dollar. The shorts are at all-time highs, et cetera, et cetera. To me, it was just oil, just press the rotation, the energy trade, and that's where it went. So now the question is, will it be almost like a self-reinforcing loop where the higher gas costs are driving CPI, which we get it tomorrow, by the way, and the higher CPI is driving inflation expectations, yields continue higher, the bond bubble continues to deflate, and with that, the bond proxies of tech. I don't think tech is going to be so easy to recover from this. I actually think it's going to be, we had that big downdraft, right, the past few weeks. That was well timed. We've talked about this, and the dollar has stayed firm and even rotated a little higher, and now we got to see what it does. If the dollar moves decisively higher, right, that 93 to 95 area, I still think oil can move decisively higher to 80, and if 80, then 100. People aren't talking about that right now, but there's backwardation in oil. There's supply and elasticity in oil. Oil's being used as an inflation hedge. It's taken the place of this money flow, and that's why some of these ETFs that I just pointed out, that Eric from Bloomberg, the ETF expert there, was saying, oh my God, the inflows have been unprecedented. I don't think it's done.
I think you're totally right? Like, you got an environment where the inputs and outputs are just unique, totally unique on every angle. And so, and what I mean by that is, like, you've got an interest rate environment that cannot move because of the impacts that it has to pensions. And then you have the reopening, which has a high demand curve, but then you've pulled forward all the construction demand that you could ever think of. I've seen, like, horror stories of people that have sticks and bricks in the ground under contract 12 months ago and didn't have inflation clauses in their contracts, and are just getting wiped out.
We've already talked about lumber has doubled since October, and 30%. It's going higher.
So it's a true kind of hedge. What Chris Cole talking about, right tail, left tail, right, of the volatility. Like, you can have high raging inflation, you can have high, deflation. And I think that, the play here is that you're going to get both, but what order right? And you're getting it into kind of an inflationary situation where that oil trade is a beautiful trade, because
But it's a dangerous
that's a
one.
great, well, oil is like, it's a widowmaker right behind that gas, right? So, it's just, but oil is highly volatile. So isn't everything volatility to an extent?
So that, and especially, Robert, who is my oil trading friend, who's going to be on Thursday for the macro to micro power hour, cannot wait, because his model is saying, okay, there are easier ways to make money. We already did. You're right. This move, Exxon and oil from October through the Biden bid, the election, the blue wave, blah, 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 blah. And then January, hot fire flames that there's money rotated into value, right? And softened in tech. And then the air pocket, right? Forced selling in tech. All right. So he's like, there are easier ways to make money. But my intermarket analysis, we're going to have like this bull bear round. It says higher. It says higher. And I hope I'm wrong, because I don't think we surely can't have an economic recovery with a headwind of much higher oil. But that's where I'm seeing the doom loop actually is stimulative oil. Even the the stimulus money. Check this out in my on my post for clients this weekend. All right, so tech rec confirms rotation, but let me just kind of get to you just alluded to this political, fiscal, monetary regime change. All of this, by the way, supports higher oil at the pump. But my point in showing the okay, where's the? I know this is making your eyes kind of crazy. Oil is inflation hedge. It's a high carry. Stimulative, here it is. So crude oil stimulus disproportionately benefits commodities. This is what is so interesting to me. Congress just passed, right, that stimulus bill, and look how much of it is going to be supportive of direct spending for consumers in this area. So it's actually, I'm trying to bring this chart up, but it doesn't really. It's this stimulus bill benefits consumers spending on oil. So I still think that we have this loop, if you will, this feedback loop of we're going to get that demand, if you will, and we have some supply issues in this because of what's happened over the past year. We've got OPEC in this, but beyond just where to put money as a hedge, meaning oil, I think this stimulus, the fiscal, is very stimulative to oil prices moving higher as well.
I totally right. Like, you're totally right. Like, this is a great trade.
And it didn't.
It's got to go somewhere.
I really thought it was going to reverse at 65.65. I really thought it was going to reverse, because that's when we had the last, and Robert and I were talking about this, the last drone attack on Saudi Arabian oil base back in 2019. That was the high, the spike high, and then from 65.65 to literally -40, right, in West Texas, intermediary in May. And then it obviously has traveled a whole $100 back. I really thought that was going to be the line in the sand. And then when I saw it go over without any resistance, I thought to myself, this is not over.
Well, it's unintended consequences, but then you got the inputs and outputs that I said a second ago. You got an entire society that has been, restricted, but then a supported price structure that wasn't cleared. Then you've got society coming back into the fold that's not restricted at a higher price level than probably is natural. Negative oil was probably accurately played there back there. Now, but then it comes back. There's some support in there for sure. Then you've got a price where naturally maybe it gets repriced at an entirely different level because it was distorted, which is to this point of the question, yeah. How is everything not dangerous when all price signals are distorted? That's kind of what I was saying a minute ago when I said, look at the historical context of some of these readings. They didn't have the same framework of data. So when I'm looking at something, if I think A and B look similar, then they need to at least have the same parameters, right? And at least some concept of parameters, if they're not exact, but they're relatively the same. We're in some seriously uncharted territory here with the fiscal and the monetary. And where does that money flow? And I think that this is a really good catch you got here.
I wrote about this actually 2 years ago, November of, it was a 2019 article about, the bond bubble. At some point, it was waxing philosophically about, bonds are stocks without a circuit breaker. Okay, which you know what I'm talking about, right? So lots and lots of folks in fixed income, and at some point the bond bubble would deflate. When, and I basically I wrote this, at some point this momentum driven bond bubble will be unwound. Granted, it's like a fully loaded locomotive, needs miles and miles to come to a stop so as not to derail, but it would be logical and ironic if in fact higher equities trigger the selling of bonds that cause the next market correction. It's going to plan perfectly when bonds roll over, check, structurally forcing rates to pop, check, then oil spikes, check, with the reflation trade, think inflation spike, check, check, while momentum stocks are sold off, check, because they're overvalued relative to value. How many checks do you need on that one? I mean, how has energy performed relative to tech in the past 6, 7, 8 months? Extremely well, and cause indices to correct. We haven't had that yet. I mean, the SPY and the Dow and the Russell are doing extremely well, right? So it means all of them. I am referring to all of them. This move could be quicker than folks think, as liquidity is challenged in bond sell-off and volatility in the bond market spills over into equities. So when I had mentioned that a few weeks ago, that this rate volatility was going to spill into equities, that wasn't the first time I had thought that or written that. That's kind of like my baseline. So I look for rate volatility to then come into the bond proxies of tech, which is why I recommended to clients, go short tech, forget VIX, because the rotation is so strong in value and energy. I just don't see there's going to be any other collateral damage than these high flying, zero dividend paying growth plays that just need to have the froth taken out. And the Fed looks like they're incredibly supportive to it.
I think that knowing what we covered right today, when we were like looking at this kind of big picture, and people watching this later, what's the net? Well, you've got an options driven equities market. And so volatility by proxy is so important to keeping that moving. And then the passive indexation, and then, the interest rate suppression. So if all things being equal, prices will head higher unless volatility is in the building, right? And so there is no volatility in the building. Look at your portfolio hedger structure, right? That is one of the cleanest measures of all that I've seen. So if you're just like, hey, what am I doing? Like, I'm just going to monitor, right? Because I can't deal with the volatility of this question, right? There's so much volatility because you're going to have extreme volatility in price action. Do I stay? Do I not? And this isn't a plug. This is genuinely, I think, this is where it's like kind of coming full circle to the first thing we talked about, is the augmentation of a changing and dynamic environment. How do I actually function in this environment? Well, you've got readings that can give you really kind of big picture triggers of whether this most dangerous mechanism is coming into the marketplace or not. And if volatility is not coming into the marketplace, it's rotation. Yep. And if volatility is coming into the marketplace, it's simply, you better strap it in.
It reprices everything.
And everything will be repriced pretty quickly. So, I think, you've got all the tools here going forward, and the different things. One of the things like me, we're focusing more on building the app there going forward than we are anything else, because it's just, having such a great feedback, and then also, so, we're really enjoying it, and it's got we think it has a lot of potential to help everybody in the market. But so folks like you that have your whole head wrapped around these rotational pivots, where the flow of funds are going, as it is all about liquidity. It's all about liquidity and volatility. And if there's a perception of liquidity, or liquidity flows into X, then that's going to run. And if they get sucked out, it's in deep trouble. I don't care. Narratives be damned. Narratives are almost, kind of going the way of the dodo at this environment. It's a rotational macro, liquidity, and then whether volatility is in its cage or not. And
but
that's it.
I think that's extremely well said. The only caveat I would put is that the Fed matters. If they let rates continue to rise, let the market price the interest rates.
100%.
Tech is going to have a hard time. And
Yeah.
if they enable, however you want to put it, yield curve control, that's also going to suck liquidity out. And that means the market is going to have a hard time.
100%. Yes,
So
100%.
Yeah.
We're at the table. We are at the end of an era, and that may be 2 months, it may be 6 months, it may be 18 months, where something has to give with the interest rates, right? Where they're going to have to go like way lower and, continue the science experiment on a whole nother level, or these things are going to normalize out of their hands. That's the key moment. That
we're in a science experiment the past few weeks. It's been fabulous.
100%. And so I think that's really kind of my takeaway, and that's why I think active management comes back into play, because
that's why I think that value has more legs, because of that rotation. It's just and I hadn't thought about it in that context of that. Actually, you can see the money flow right with it, but you can also see the logic behind it, where that kind of makes sense, right? That momentum to anti-momentum or growth to value, it actually is more durable than I think people trust right now, because of, remember how we said 28 head fakes, no question. But right now, what's the alternative? Allow VIX to reprice everything, or they let this run up and value takes over. I think it's brilliant.
Yeah. I mean, you only got so many plays, right? And you got, I think that this at least plays until the reopening, can see how that goes. And I think one caveat I have that I've been kind of thinking about is if direct fiscal stimulus ends here, right, with the 1.9 trillion and shit, then that is totally got to be discovered what that kind of functionality does, because the Fed then is totally on they're totally in the corner by themselves. So you wonder if you're going to continue to see direct stimulus stuff going forward. And
I think you're going to directly see more stimulus stuff going forward. I think they're fine with a higher dollar a little bit. It's de facto tightening. They've obviously let yields rise without talking them down. They're way far from doing yield curve control. They can see the SPY and Russell and Dow. They're doing fine. Rotation to old tech, rotation to energy and value. I think this is, so far, the playbook is working out, and I'm just trying to follow and position it. But when I saw oil spike higher, I thought, my God, is that the next? Gold sometimes is the next VIX. Right now, oil is the next VIX, and it does. They move from hedge to hedge to hedge. So in any case, this will change very much if oil gets completely out of control. And I don't want to call it, but I do see the potential for oil getting out of control, and that's something the Fed can't control.
Yeah, I think 100%, and I think the inflation. If you have runaway or start to see heavy inflation, they have to come with UBI types measurements, like continued stimulus, because people can't afford the wages,
or they keep feeding stimulus to the energy plays. I mean, it's completely stimulative to oil.
So none of the stuff that we've talked about historically is off the table with China or with anything else. It's just,
that's still always a wild card.
I think the big thing now is how does the reopening go this summer with and I see that it's hot and it's gonna the economy's gonna run hot and all that stuff. Well, I mean, obviously everybody's been cooped up. I mean, shit, I'm ready to go. Anything besides just sit in my house, and I want to go to a meeting with people. That's the worst thing anybody can say. I love it. Let's have a meeting, like just in person, right? So I get it. It's gonna run hot, but then, right? What is the unintended consequence and the knock-on effects of that? So it's like this oil call is fantastic, because that's a knock-on second order thinking thing. That's like, this is going to happen, this is going to start playing out, as opposed to just direct correlation stuff, which I think is the only way forward.
We'll see. But definitely oil is the next VIX, is my call. And it still has to play itself out, and it has to stay above 65. But in the meantime, your sentiment on liquidity is spot on. So We will revisit whatever we have next week on Tuesday, but for now, I think this is a great place to end. And thank you again for joining. After this episode is uploaded to my YouTube channel, and I'll leave Jonathan alone for a week so he can continue to crack the whip with his developers and get this platform launched. It is so exciting. It's so exciting. Can't wait. You'll need a vacation after that. Seriously.
Nah, we're coming. We want everybody in the world to be able to use this. We'll keep working.
All right, then don't cry if you don't get to sleep. All right. Have
Thanks.
a great night, and thank you for joining us.
Thanks,
Bye.
everybody. All right, bye.